In this lecture example, we're going to be looking at section 19 and a little bit of paragraph 12a with the concession and compromise of debt. Now, the majority of this section is pretty straightforward. I will point out to you a couple of lecture examples and areas where there's a bit of concern, and I'll talk to you about what those concerns are. Alright, let's first start with example 1, nice and simple. This example shows the effect of concession of debt on inventory. A Limited is a registered VAT owner with a 31 December year end. All amounts below exclude VAT. They purchased 100,000 units at a cost of 10 rands per unit on the 1st of February. Okay, so I want you to see, there we go. They then sold 20,000 of these at 15 rands a unit. There we go. A Limited ran into severe cash flow problems and could not settle the amount owing to the supplier, XXX, and they agreed to write off 900,000 rands off the outstanding debt. Now what I want you to understand is that this 900,000 of the outstanding debt, if you think about it, it basically, if our total cost was 10 rands per unit, which gave us a million rands, and now they're writing off 900,000 rands, it means they're writing off 9 rands a unit, basically. Now, what I want you to see is they tell you, calculate the implications. Now remember, they purchased 100,000 units and they sold 20,000 of those units, so there's 80,000 of the units left. Now, what I want you to see, what basically happens is how we apply this debt benefit. The debt benefit of 900,000 is as follows. You will first apply it to the inventory which is on hand, right? And remember, the inventory on hand, 80,000 units, 10 rands a unit, 800,000. So you'll apply it there. And then whatever the remaining balance is considered an excess. Okay, so we always basically first apply it to the base of the cost of the asset, and then the rest is always a recoupment. This same principle we follow through basically when we're looking at the assets as well, like capital assets. So it's first applied to the inventory is still on hand, and then the balance is recouped. Number 2, this example illustrates a situation where there is a debt reduction amount that was incurred on deductible expenditure that is not inventory or an asset. A Limited is a registered vendor. All amounts below exclude VAT. They obtained a loan of 200,000 to pay salaries, and the creditor wrote off the loan. Right, so 200,000 rands deduction, the full 200,000 is a recoupment. Example 3, right, now this you might have already seen this example when you look at paragraph 12a. This example illustrates a non-allowance asset, so there's no section 19 application here. Okay, so X Limited took out a loan of R1 million to buy a piece of land. In year 3, 2 years later, they agreed to write off the loan if X Limited paid 100,000 rands. So they're saying, you owe us R1 million, if you pay us 100,000 rands, we'll write it off. So basically, the debt benefit is 900,000 rands, which is the first question. Then I ask you, what are the tax consequences if the land was still on hand at the time of the reduction of debt? So, when the time they give us the reduction of debt, the land is still on hand. Now, the base cost of this land is R1 million. The debt reduction, this debt benefit is 900,000. You will reduce the base cost first. Right. That gives a new base cost. Then I ask you, what are the tax consequences if the land was sold for 800,000 in year 2? Now remember, they wrote this off in year 3. But now we ask you, what happens if you sold it in year 2? So in other words, this is before, if you sold it before you got the write-off. So what I want you to see is, pay attention here. In year 2, remember in year 2, you don't know what's going to happen in year 3. So in year 2, we would have done this calculation. Proceeds, 800,000 rands, less the base cost, gives us a capital loss of 200,000 rands. Okay? Because remember they said we sold it for 800,000 rands. Then in year 3, we receive our debt benefit. So the first thing that you do is you have to now go and recalculate the capital gain by first adjusting the base cost. So we say, at the time that it was sold in year 2, my base cost was R1 million. So let me now adjust that base cost to a new base cost. Then I say, if in year 2, when I did this calculation, it had been proceeds, which is that same amount, 800,000, minus my new base cost, which is null. Oh, sorry, 100,000. Right, 100,000, which is this amount over here. This gives me a new capital gain. So I'm saying the total capital gain is 700,000 rands. In the previous tax year, I had a capital loss of 200,000. So I have to pay in 900,000 rands this year to correct it. If in the previous year I had a capital gain, let's say, of 300,000 rands, then I would pay in now 600,000 rands. So you just have to add up. So over the total of the 2 years, it adds up to what it is. Then D says, what happens if I sold the land for 1.3 million rands in year 2? So I'm just changing the amounts here. So in year 2, if I sold it for 1.3 million rands, I would have a capital, sorry, it says here loss, but it's obviously a gain, capital gain of 300,000 rands. If then in year 3, I have to redo it, so the first thing I'll do is I'll calculate a new base cost. I'll then say proceeds less base cost of 100,000. It gives me a capital gain of 1.2. How much recoupment did I calculate in year 1? Or capital gain, sorry, 300,000. Now I'm saying it should be 1.2, so the difference is 900,000, and that's what gets taxed. Okay, now, the next example is the one which is a bit of an issue for me. We don't currently have examples, proper examples on how to do this, because the previous interpretation note which was issued, although it gives us some guidance, there's been some changes to it. So guys, what I've done, you'll see here, A and B of this question, if you can do those, I would say you're fine. C is a situation where the asset was disposed in the previous year and now you're recalculating it. Now, I'm going to show you how I would do it, because like I said, guys, there's no guidance. I've looked at the interpretation out of SARS in the past and textbooks, and I've cobbled those things together to give you an example, but there's no real example with numbers like this out there. Okay, so I'm going to explain it to you. So let's go. X Limited is a manufacturing company for 31 December year end. X Limited purchased a new manufacturing machine at a cost of R1,000,000 on the 1st of January and immediately started using it in production of income in year 1. In year 2, they sold it for 850,000. Okay, so now I ask you, if all of the above facts apply, what are the income tax implications? So this is now a normal situation, there's no debt reduction. So first I'm just showing you so we can go get onto the same page. So year 1, you'd calculate section 12C at 40%. Year 2 is the sale of the machine. Okay, so remember the year 2 section 12C allowance. We calculate selling price limited to original cost, recoupment of 450, and we have no capital gain. Now what I want you to see here is that this 450,000 rands recoupment here that we got it forms part of the proceeds from sale of assets. Now what does that mean? It means I sold this asset for 850,000 rands. 450,000 of that 850,000, 450,000 of it is a recoupment. So it comes from this selling price. Okay, so there's no capital gain here. Now, if I look at part B, I say the supplier agreed to write off 500,000 rands of the debt on the date that the machine was sold in year 2. So this is now debt write-off on the same time that the asset is sold, so in the same year. So year 1, 40% allowance. Year 2, 20% allowance. Sorry, I should obviously just show there, 20% allowance. Okay, that gives us a base cost of 400,000. Our new base cost will be null. So remember, we've got now a debt benefit of 500,000 rands. We take 400,000 of that 500,000 to give us a new base cost. The remaining 100,000 rands is a recoupment. I want you to see over there, that 100,000. Now, this recoupment does not form part of proceeds from a sale. So why are we getting this recoupment? Not because we sold the asset, but because we received a debt benefit. Now that becomes very important in a second, because now, in the next step, we calculate the recoupment. I want you to see, we calculate as normal, costs less allowances. because the tax value that we've always learned to calculate does not do anything with this debt benefit. That's an issue for the base cost. So we do everything here the same. Cost less allowances gives us a tax value. Selling price limited to original cost. Right, gives us a recoupment of 450,000. Now I want you to just see that 450,000 rands recoupment there. 100,000 rands of that amount has already been taken into account. You can't recoup more than that. So we've left with 350,000. That 350,000 rands, this recoupment forms part of proceeds. Now why is that important? Because when we do the capital gain, that amount gets deducted. 350 there, not 450. I'm going to take you back to A. Look what happened in A. In A it was 450,000. Why? Because the full recoupment arose from a sale. Now that recoupment that arises is 350,000 rands from the sale. So 850 minus 350 gives us 500,000 rands proceeds. Our base cost is null and gives us a capital gain of 500,000. Now that works out because they wrote off 500,000 rands. Right, now look at what happens in C. I want you to understand in C, the net effect over 2 years should be the same. In C, we write off the 500,000 rands in year 3. So what happens now in C? So in C, year 1, we claim 40%. Year 2, we claim a normal allowance. Right, everything normal. Because 850 minus 450, because it's the same as in A. So year 2 is the same as in A. Why? Because we didn't know we we're going to have a debt reduction. So I want you to pay attention here to the proceeds. 850 minus 450, because the full 450,000 rand recoupment comes from a sale. Now in year 3, we receive our debt reduction. So now we have to go back to year 2 and redo it. So the first thing we do is we recalculate the base cost. So in year 2, our base cost was 400,000, remember? We now take our 500,000 rands debt benefit, and we take 400,000 of that, and we reduce our base cost to null. So we're left with 100,000 rands. This 100,000 rands is a recoupment, as you can remember. But now I want you to understand, this recoupment not form part, so does not form part of proceeds. Okay. We then re-perform a capital gain. Watch now. Because in year 2, I want to remind you, in year 2 we had 450,000 rands to be calculated. Now we say that 450,000, 100,000 rands of that is in terms of section 19, and 350,000 of that is in terms of section 8.4a. It has to work out like that because that is what we saw in part B when we worked it out, the 100,000 and the 350,000. So why is it important? Because in year 2, we believed that the 450,000 rands was all from section 8.4a. But now we revise and we say, no, 100,000 is section 19 and 350,000 is section 8.4a. So this is a retrospective adjustment. Why is that important? Because when we then recalculate our capital gain, only 350,000 rands of that forms proceeds. So look at the capital gain, 500,000 rands again. And that is correct. B and C, the capital gain must be the same. So guys, C, this is quite complicated. This whole process I discussed here. I understand that it is quite complicated. And that is why I would recommend focus on A and B. There are no real examples out there in textbooks or any other material of this example I've done here. So I would recommend A and B. Those are a little bit more discussed, and do those. The reclassification here, guys, why do I keep doing this reclassification of the 100,000 rands? Because if you go and look at paragraph 35.3, this is the section that tells you that when you calculate proceeds, you must deduct the recoupment. That paragraph 35.3 says it must be amounts that arises from the proceeds of the asset. So they're trying to say a recoupment that comes from the selling of an asset. This 100,000 rands recoupment we see here does not come from selling the asset, it comes from you receiving a debt benefit. So it's a different type of recoupment, and that is why it's not included in there. And then guys, example 5 here is just to show you different ways of calculating the debt benefit. And this is just a little bit of theory, very simple, as discussed.